afternoon, everyone, and welcome to our Daily Mirror Cost of Living Facebook Live, where each week we discuss how the cost of living crisis is affecting you, all the help available, and the big money stories of the last week. I'm Levi Winchester. I'm the money editor for the Daily Mirror website, and I'm hugely grateful to be joined by the Mirror's head of business, Graham Hiscott. Welcome, Graham.
Hello. Hi, Levi. Hi, everyone.
Hi, thank you so much for joining us again. So this week we're going to be talking about interest rates. After about an hour ago, the Bank of England confirmed that it's hiking its base rate from 1.25% to 1.75%. So that's a 0.5 percentage point increase and the biggest rise in 27 years. Now, the base rate is hugely important for lots of reasons. It's used by banks and lenders to determine how much they charge you on lots of different products, including mortgages and other debts, but it also has an impact on any savings you have as well. So what we're going to do today is going to break down exactly what rising interest rates mean for your money. So please drop us a comment below or email us at mirror.money.saving@mirror.co.uk. So Graham, I know we've briefly touched on it just now, but can you recap sort of what has happened today?
Yeah, thanks. Yeah, thanks, Levi. Okay, so what's happened today is, as you say, it's increased to 1.75% by the Bank of England in its base rate. That was broadly expected. The idea is that you in normal times is that you increase the bank increases the interest rates, or influences, as you say, others to increase their interest rates as well, which is supposed to kind of keep us from spending more on other things like going out and buying a telly or a car or something like that. That's trying to take some of the heat out of inflation. And why the bank needs to take heat out of inflation is that it's already at a 40-year high, over 9%. And it also gave a series of updates today. And one of those updates was that it's warning that inflation could hit, wait for it, over 13% in October. And that's almost entirely down to what's expected to be, or what will be, another big increase in energy bills and the price cap on energy bills for about 24 million households in October. So that's what it's done. It's hoping that by restricting how much we spend on other things, we may take some of that heat out of inflation. But it's also about giving us expectation that inflation will come down over time. So it's telling us how much inflation will be in time, or how much it thinks it will. And just a couple of things to add, Levi, is that one thing, it's thinking that inflation will get down to its target of 2%. That's 2% when it's now over 9%. Is that it will get down to 2% in about 2 or 3 years' time. So still some time off. The other big news from today, though, is about the state of our economy, which has already weakened significantly. And what it's now saying is not only will we go into recession later this year, but it could be one of the worst. It could be a recession in line with those that of the 1990s. So it's warning of some very worrying economic storm clouds ahead. So that's a brief recap.
No, and as you said, obviously lots to digest today. If we focus back onto inflation and interest rates, obviously, as you said, the Bank of England is now predicting inflation will hit 13.3% in the fourth quarter of this year, which is obviously huge. And they're also saying it will remain above 10% until the middle of next year. So with inflation set to remain high and certainly well above the 2% target that the Bank of England has, are we likely to expect more rate rises?
We are. In fact, the economists have been sort of scrabbling around this morning to update their forecast and what will happen. So, as you said, the base rate is at 1.75% at the moment. The best guess forecast is that there will be another series of increases, and that it could increase to 3% by the end of this year, potentially, or more like potentially the beginning of next year, early next year. Now, those who are listening on Facebook with memories go back far enough will know that that's still very low in comparison to when they were sort of over 10% and higher a few decades ago. But yeah, that's their latest forecast. Now, how fast those will increase to 3% is unknown. some economists are thinking that we might have another half point increase in maybe September and November. But the Bank of England is somehow going to giving this mixed signal saying, well, they're not. Don't bank on what others are saying, because it's up in the air at the moment. A lot will depend on, I think, how the economy pans out. Really, how bad the recession might be.
No, quite. And just before we start to delve into what these interest rates mean for you, I mean, do we have any idea when we could start to see inflation fall back down to 2%?
Well, I'd say it's going to be some time off. Yeah, I mean, it's going to be at least a couple of years or so. The fact is, no one really knows, because a lot of what is driving inflation is commodity prices, and in particular oil prices and energy prices. And the reason why that's gone up so significantly is because of what's happening in Ukraine, with Russia's war in Ukraine. And sadly, no one knows what's going to happen with that. So if there were to be a resolution, and let's hope there could be anytime soon, then that would perhaps take some of the heat out of those commodity prices quite soon. But no one knows what's going to happen with Ukraine. So the longer that continues, unfortunately, the longer inflation will stay high.
And with the interest rates today, let's start to delve into what this kind of means for people's finances. So if we start with mortgages, obviously there are lots of different types of mortgages out there, and the type of deal you have will determine if you're affected by the rate rise or not. So, Graham, do you want to delve into what the interest rate rise today means for homeowners and people with mortgages?
Yeah, I mean, a thing to remember is that I think the figures about you'll know this, Levi. 8 out of 10, I think, mortgage borrowers are on fixed rate mortgages. So essentially, as of today, they won't be affected by any increase in these in the base rate, even if they're. But there are lots of those. I think the figure's about 2 million now who will be impacted potentially, because they're on what's called variable rate mortgages. So it could be that they're on a tracker mortgage, or they're on or their lenders assign a variable rate. It's not a given that the tracker will. Those on tracker mortgages will see their rates go up pretty much straight away. Their variable rate depends on whether their lender passes it on. So, but you're still talking about 2 million households who will see their bills go up. Now, obviously, it depends on the size of their mortgage. I think the last time I saw a figure, again, Levi, you'll know this, I'm sure, better than I do. I think about £150,000 mortgage. This increase alone could add about £32 a month. But that's obviously on the back of the other 5 base rate increases that we've had since last December. So that's
a really important point as well, is the fact that this is the 6th time in the row that they've gone up. So it's not like homeowners are just having to factor in this one increase. You know, it's all the other ones that have happened as well, which, yeah, as you said, has a huge impact on people's bills, you know, adding potentially hundreds of pounds.
That's right, definitely hundreds of pounds, and also even those that were on fixed rate mortgage. I think it was the Lib Dems who put out some research yesterday that they said, again, it's a 2 million figure, but it's the thing that they said over the next 12 months, about 2 million homeowners, mortgage borrowers, will be coming off of those fixed rate mortgages. And again, Levi, you know this much better than I do, but a lot of those people who will see a real bill shock, because let's say they took out their fixed rate 2 years ago, and particularly maybe 5 years ago, when mortgage rates were incredibly low, at rock bottom. And so they are going to be quietly, because we won't necessarily see the impact in one go, they're going to be quietly seeing a big increase in their repayments when they either come to try and get another fixed rate deal, or if they go on to their lender's standard variable rate. So there's a lot of quite a big bill shock for a good number of people, even if they aren't affected immediately.
And obviously, with inflation expected to carry on rising, and we can expect interest rates to likely carry on going up as well, would you say it's wise for people to consider locking into a fixed deal now?
Yeah, that's a good point, Levi. And I think the answer is probably yes. And my understanding, again, this is where you are the pro, but I think that you can lock in to a fixed rate deal. Is it within 6 months, or it might depend on your particular It's about approximately 6 months. Okay, so actually, perhaps you're the expert on this, but so if your mortgage is, if the term currently the fixed rate term of the rate you've got is due to expire within 6 months, what would you suggest people do?
I'd firstly say check the terms of your mortgage deal, because 6 months is just the kind of rough figure that experts give for when you'd be able to switch to another deal. But yeah, I think it's definitely worth using a free mortgage calculator online and just looking and seeing if there are potential savings to be had elsewhere. Obviously, as you said, Graham, a lot of people are going to have a bill shock if they're coming off their fixed rate deal, because when interest rates are going up, even the new fixed rate deals that are coming out, you're going to notice they're slightly more expensive compared to, say, a year ago. So that's one thing to keep in mind. You should also be aware of early repayment charges, particularly if you have a 10-year mortgage. So there's lots of different things to factor in, but always use a free calculator online and just look at the overall picture of your mortgage term rather than just the kind of immediate short-term picture, I would say. Is there anything else at all to add on to about mortgages, Graham?
No, I think that's I think that's the. Would you agree with that? That those that lenders don't always necessarily pass on, even if you're on a standard variable rate mortgages. What's been the experience in the last 5 base rate increases? Have you seen that they've passed those on immediately, or has there been some delay?
Absolutely, we've seen some of the major high street banks and lenders announcing that they're going to pass on the rate rise as soon as, the same afternoon as the base rate is announced and the next day. So yeah, I mean, a lot of lenders do tend to not sit around when it comes to announcing the changes onto their mortgage products. I mean, again, it obviously varies depending on who you're with, but the best thing to do is obviously keep an eye out for any emails from your bank or your mortgage lender. And if you think, oh, sorry, excuse me, my computer's doing some strange things there. Yeah, no, we did notice a lot of people putting their rates up very quickly last time. So yeah, it's definitely something to be aware of.
And Aoife, actually, can I ask you? Sorry, throw questions back. On mortgages. How? I mean, the mortgage market has been generally very competitive, hasn't it? Still, are there? How much of those sort of new fixed rate products, so new fixed rate mortgages, how much have those rates been increasing? You think lots of competition that actually, there'll still be loads of really good deals out there, but is that no longer the case?
I mean, I'd say it's still worth doing your research and comparing prices out there, because particularly if you are on a standard variable rate, you're likely to find something cheaper elsewhere. But certainly we have noticed that, a lot of cheap deals are kind of have been pulled from the market over the last few months, because, when interest rates get higher, this is what happens. The banks and the lenders, they put their rates up, and as you said, it becomes more competitive as well.
Okay, great. Should we talk about savers? Is that the flip side of all this?
Yes. Actually, before we move on to that, let's just talk about people with loans and credit cards and car finance, people in debt, basically, which, obviously your debt can suddenly become quite a bit more expensive after today.
Yeah, well, exactly. And again, as you said rightly at the very beginning, this rate increase in itself influences how much lenders, whether they be mortgage lenders, but as you say, other forms of lenders, personal loans, overdrafts, credit card rates, car finance. It doesn't you won't be looking at for instance, your credit card statement and have noticed that the interest rate will have gone up by half a point. It depends on obviously what your provider chooses to do, but the pressure is upwards on all of those products. Again, it comes sometimes down to competition in that market and how much they want to how much they need your business, basically. So it's not an inevitability that those borrowing costs will go up, but the worrying thing is it's an upward pressure, and and these are increased outgoings when obviously don't need to explain to anyone who's listening in today knows that all the other increases, all the other bills that are going up at the moment, food, energy, insurance, you name it.
No, absolutely. I think it's worth noting with credit cards as well, although generally speaking, they're not explicitly always linked to the base rate, but we're still seeing that lenders and banks, the rates are going up regardless of that. So do obviously keep an eye on your credit card. Best thing to do is if you notice that your rates are going up, see if you can benefit from a 0% interest rate credit card. So then you're not obviously paying pricey interest on what you already owe. But obviously do keep in mind only those with the best rates will get accepted for these type of deals. Best thing to do is use a soft check calculator online to check your eligibility, because then this doesn't affect your credit score. Generally speaking, people with loans, usually when you take on a loan, it's at a set rate, so you shouldn't notice this go up. But what you may find, again, because of competition and because interest rates are going up across the board, just generally speaking, you may find a lot of cheap loans are going up in price, which makes it more expensive to borrow if you're a new customer. So that's obviously something to bear in mind. It's going to perhaps become a little bit more expensive for people who are struggling and who might need to borrow money right now. So yeah, that's another thing obviously to keep in mind. And then, Graham, you were mentioning earlier about savings. I think let's move on to perhaps one of the only winners from the interest rate rise today, people with savings.
Well, yeah, exactly. And I tend to think, I don't know if you agree, Levi, that the savers tend to have been sort of the forgotten victims through over a decade now of record low interest rates. I mean, banks have been taking advantage of us, particularly the big banks, for God knows how long, really, by giving really pitiful returns on savings, particularly the big banks, particularly those that have stuck with them for a long time. So a real penalty for loyalty, if you like. That's right. In theory, that there is the flip side of this is that if you've got money, if you're lucky to have savings, then you could potentially earn more on that, an interest on those savings. But big caveats. Again, Levi, you know this better than I do, but that's if they pass them on. And as I say, there's a lot of providers who just don't need to. They're not required to increase savings rates. They often don't need to, as I say, because they've got plenty of funds. They don't need to attract more money in. And the other thing is, I was just looking at some research that had come in on today's, and it said that even if you're earning the extra 0.5% interest on £10,000 in savings will provide, wait for it, £50 a year extra. So that's 50 quid a year extra. When you think that your energy bills could be going up by 1,400 quid in October, it's a silver lining, but it's not much of one, really. And savers shouldn't expect necessarily it to be passed on. Providers tend to be not very generous, it's going to barely touch the side when it comes to these other things, these other outgoings that are going to be going up.
We've also seen a few examples of where banks have put their rate up, but customers are expected to call up and actually have to ask for this rate. Not all banks do that. A lot will just put you on that higher rate automatically, but it's definitely something to bear in mind, just to make sure that you're not your money isn't languishing on that lower rate, because I think most people would assume that they'll automatically get that. But yeah, we've heard from a few readers who've said, I didn't realise I was still on the lower rate and I had to actually call up my bank to ask to be put onto that. So that's another thing to bear in mind as well. And of course, the other point with savings as well, they are still hugely below the rate of inflation. In the top paying easy access account right now is Virgin Money with a rate of 1.7%. And obviously compare that to inflation right now, which is, as you said, at 9.4% and rising. It's not a great deal, is it? You will obviously get more for your money if you go into a fixed rate account, but then the downside to that is if you urgently need your cash, you won't be able to access it for a set period of time. Sometimes you can if you pay a penalty fee, but then you're essentially going to wipe out any kind of interest you've made plus plus maybe more. So I think the top paying 1 year fix right now is from Oak North Bank, which pays 2.85%. Or if you look at a longer 5 year fix from Shawbrook Bank, that pays 3.4%. So again, both hugely below the level of inflation right now.
Yeah. Do you think, Levi? Do you think in these times as well, particularly when we see inflation go up even more, people are going to be looking around wherever they can for to try and get some sort of returns that are nearer to 9% inflation or whatever, and obviously it's going to go any higher. If people, you talked about some of the top paying sort of fixed rate products there. If people begin to see products that are offering 5, 6, 7, 8% sort of rates of interest, what would your advice be? Because in these times, there'll always be those that there'll be providers, there'll be sort of offers like this. What would you say to those that see rates like that?
Yeah, I would absolutely say, again, it's always about comparing deals, comparing prices, do your research first, and just make sure that you are currently getting the best rate for your money. Again, as you said, it can sometimes take some lenders and banks a little bit of time to pass on any savings. So perhaps wait a few days, maybe a couple of weeks after today's announcements, just to see who kind of nudges their rates up just ever so slightly. Yeah. I'd also like to flag as well, particularly for people who are on benefits, working tax credit or universal credit, the government does have the Help to Save account, which is kind of it's an unbeatable rate compared to other savings accounts right now. So you get a bonus of 50p for every £1 you save over 4 years. So, compare that to the top paying accounts right now, and, it just can't be beaten. So definitely, if you're on universal credit or working tax credit, definitely worth looking into that, because, you won't find a better rate for your money.
Yeah, exactly. I should also say, when we're talking about 7, 8%, etc., perhaps these deals are too good to be true. So perhaps there's a bit of you'll know more about that. So, is there? I haven't. Do you think, is there any impact on pension funds, etc., when inflation goes up like this? Is there sort of any fallout for those sorts of products as well?
That is an interesting question. Again, I think I would just say to anyone who's worried about their pension, look with their provider and just make sure they're getting the best rate. I would say we've obviously got the pension dashboard coming, which will make it a lot easier for people to keep an eye on their pensions and to keep track of their money a little bit more.
Yeah. Okay, I'm just looking at I don't know if you've seen any comments from the readers. Lots of commentary about the Tories. That's certainly very applicable. And one thing I would say about today's announcement there is that in fact, in the paper today, we covered some comments by a former Bank of England rate setter. The rates are set by a committee called the Monetary Policy Committee, and there was a former member of that committee called Professor David Blanchflower, who admittedly is quite a critic of the bank since leaving. But anyway, he was saying that the Bank of England has lost the plot, in his words, and because his argument, and it's shared by others, and there are some unions that have come out and said so today. They think that this is the wrong timing. They're saying, why put up rates now when inflation is being driven by, it's not by people going out and buying the latest flat screen tellies or spending money when they that's burning a hole in their pocket. It's being driven by, as we talked about earlier on, by things like oil prices and commodity prices and things that are way outside of anyone's control. So there is an argument, there's a counter argument, that this is actually going to push the economy further into recession. So the idea is that if you push up rates, you push up borrowing costs, as you were explaining, Levi, then what happens is that people rein in the spending even more. What does that do? That means that there's less money flowing around the economy. That means that the recession could be worse. And in fact, rather than increasing rates, Professor Blanchflower is among those that actually thinks that the Bank of England should be, cutting rates. In fact, he thinks that they should have cut the rate by as much as the Bank of England today increased it. So there's an interesting counter argument, and one that I think would be interesting to hear those that are listening in on Facebook share that view, or they disagree with that. But yeah, as I say, there is an argument to say that that they're putting up rates, borrowing costs, at the worst possible time, and it's not just consumers that are impacted by it as well. There's businesses as well who are impacted. I've seen again one bit of commentary today is that this increase will add about £2 billion to businesses' borrowing costs. So again, that's more money going out the door in interest payments than in being able to invest in their own businesses or potentially pass on make wage increases. So it's a controversial decision to do what the Bank of England has done today. Hindsight will tell us if that's the case, but the bank is in uncharted territory. So it's doing what it thinks is best to bring inflation back down to that target of 2%. Whether this is the right decision at the right time, I think we'll only know, with the test of time.
And of course, we mentioned just so slightly about the only winners really of this kind of rate rise being savers, but of course at the moment with the cost of living crisis seemingly getting worse every day, it's never been a harder time for people to start saving.
Yeah, exactly, and it's an odd one though, because actually I was covering the Lloyds Bank results fairly recently. There's a big cohort of people who have got money and are actually putting more aside. In fact, Lloyds Bank were talking about the amount of money the amount of deposits that they've taken in. I think it was something like 2 billion in the last 6 months or something. May not be quite right, but anyway, there are those that are squirreling money away, but they're the fortunate ones. There are a lot of other people who are beginning to dip into their savings to pay for essential bills, and even more worrying, of course, are those that are beginning to use things like credit cards to pay for essential bills, which Levi, you're the pro on this, but is a very worrying thing to do. Although you did say clearly about the advice that if you are going to use a credit card, there are interest-free both money transfer and purchase 0% purchase cards out there. But I guess the key message would be, if you're starting to put something like your energy bill on your credit card, if somebody came to you and said that they were doing that, what would you be thinking?
I would say before you do anything, talk to your energy provider straight away. Let them know you're struggling, and they might be able to offer you a payment plan or some other form of tailored support. A lot of the major energy providers as well at the moment also have hardship funds that are open and charitable grants. I know the British Gas one reopened very recently, and that's actually available to anyone. It's not just British Gas customers. Yeah. Always seek free debt advice as well. So from charities like Step Change, National Debt Line. I would say the absolute key message for anyone struggling is, don't struggle in silence. Talk to someone, talk to your bill provider, and just get the help that you need, basically. Obviously, we do have the cost of living payments that are coming in as well. So we've just had the first half of the £650 cost of living payment for most people on the eligible means tested benefits that the government have previously announced. That's people like universal credit, pension credit. People on tax credits are going to start to get that first half of the payment from September. And then the second half for both groups is going to come at a later date. They're saying it should be around winter time, so keep an eye out for that. There is also a £150 cost of living grant coming to those who claim certain disability benefits, such as attendance allowance. And there is also a £300 grant coming in for pensioners who are in receipt of the winter fuel allowance. So definitely keep an eye out on these payments coming into your account over the winter. And I think the kind of major hope for most people at the moment is that the government will announce more help for people, because since announcing that, the predictions for how much the energy price cap is going to go up by have skyrocketed even further, and all the major charity groups are saying the same thing, that it needs to be addressed and more help needs to be done for people.
Yeah, just to add to people, the woes today, I'm afraid, but we've also had the announcement from Ofgem, who were the energy regulator, confirming what we pretty much knew was going to happen anyway, but that we talked about the energy price cap earlier on, which they normally look at twice a year, to change it twice a year. For the last few years, it's been going only one way, and that's up. But anyway, they used to change it twice a year. Well, they're now going to change it 4 times a year. So the next time that will happen is January, very usefully right after Christmas, and right when people are using the most heating generally. So they've decided they're confirmed basically that they'll be reviewing that price cap 4 times a year. So in January, that might mean another increase. Their argument for doing so is that it will prevent more energy companies going bust, which we saw a whole swathe of that happen earlier this year and the back end of last year. But it's for those consumers listening, those customers who are listening in to this, it won't be scant relief when you think that bills are going to be going up even further in January. That's certainly the prediction at the moment.
No, absolutely. As you said as well, an astronomical change to the price cap, and what essentially it means is your bills are going to be rising and falling a lot quicker. And as you said, it couldn't come at a worse time really for people who are going to be having a hard Christmas and when you're using energy more. But keep an eye out for the help that is out there, and obviously on the Mirror website we'll be updating our page with all the help that is available and hopefully pointing you guys in the right direction. Perfect. So I think we're going to have to leave it there, I'm afraid, because we are just about out of time. But thank you so much for joining us again, Graham. Always a delight to speak to you.
And you, Levi, definitely. And you. And
thank you so much, everyone, for tuning in. We'll be back again next Thursday at 1 p.m. for another Facebook Live session. We'll see you then. Thanks.